Will Uranium Royalty Corp absolutely skyrocket? What does Uranium Royalty Corp do? It's the first company to apply the successful royalty and streaming business model exclusively to the uranium sector. So what is the royalty and streaming business model? The way it works is companies will provide investment capital to a mine, and in turn, the mine will pay the royalty and streaming company a stream of passive income revenue earned from the mine, right? So there's very little cost, all profit. It's an incredible business model if you can own a royalty that just gets a perpetual stream of passive income that increases over time, right? So it's a truly incredible business model. And what makes this company so special is it's already generating profits, right? Price to earning ratio 54. That's high by the standard of most stocks. But royalty companies get a massive premium because they don't have any costs really associated with them. It's all profit. They put up the money up front, and then they just get passive income in perpetuity, especially if they have royalties over big mines. Here's one example of an extremely successful royalty corporation, Franco-Nevada. In 2010, the price was $17. Now it's $133, and it pays a dividend of 1%. That's what can happen if you own the company that controls the royalty streams of mines that are growing exponentially and cash flowing exponentially. So this company just right there looks super solid. They're already generating profits, but what do the financials look like for this company? Well, this is their balance sheet. Total assets, $278 million. Total liabilities, $2.9 million. So they have net assets of $275 million. Right? That is massive. That's exactly what you want to see when owning a royalty, when owning a company, right? Current assets, $232 million, $30 million of cash. Now we have to look at their cash flow statement to understand where they're getting their cash from. This is actually really, really important, right? They got $30.7 million from net issuance of stock. Right, so they are printing shares and selling them into the market. A lot of these companies are doing that. A lot of miners are doing that. This company is also doing that. Now, hopefully they're using that money, investing it in future royalty streams from mines that can cash flow in perpetuity, and they can get a massive ROI on their investment, right? That's the only way printing shares works. If you generate a huge return on the investment of the capital, that's the only way it's not dilutive, right? You want it to be accretive. So let's dive into exactly what this company is up to and what the future looks like. So they have a strong balance sheet, which positions it to capitalize on accretive uranium royalty and streaming acquisition opportunities, right? We hope they're accretive. Physical uranium ownership through opportunistic market purchases, the supply stream with CGN Global, and a strategic arrangement with London-listed Yellowcake PLC. URC holds interest in physical uranium acquired at cyclical lows, right? That's pretty massive. So they own interest in physical uranium, which we know is in a multi-decade supply crunch. Their portfolio includes interests on 19 development, advanced, permitted, and producing uranium projects in multiple jurisdictions, including royalties on the world-class McArthur River and Cigar Lake mines, right? Those are huge mines. This company is generating cash on it. So Uranium Royalty Corp has partnerships with some of the biggest producers and developers on the planet, right? Uranium Energy Corp, Cameco, Orano, Paladin, Encore Energy, Energy Fuel. So it's well positioned and diversified and taking advantage of the growth in all these other assets, right? That's the beauty of owning a royalty company. You get all the profits and none of the CapEx, right? You put up the capital up front, and you're supposed to generate a massive return on investment from pure passive income streams. This is their globally diversified asset portfolio, right? McArthur River, Cigar Lake, all these projects. So that's up in Canada, the Athabasca Basin, right? Then they're huge in the United States, which is, again, very positive, very early stage, right? Arizona, Utah, New Mexico, Colorado, Wyoming, right? So they have a stake in a bunch of different projects. So let's dive into this portfolio, right? McArthur River, stage in production, proven reserves, 317 million pounds of uranium, and they're earning an income stream from that. So massive. It's like a high upside way of getting exposure to Cameco's cash flows, right? Cigar Lake, Waterbury stage in production, proven reserves 135 million pounds. Now they're not going to get all of it. They're just going to get a piece of it. So they're cash flowing already before the nuclear renaissance really takes off. Then they have a royalty associated with the Rough Rider project, which they're saying has 28 million indicated pounds in the ground. Then they have exposure to Rough Rider, which has indicated pounds, 28 million, inferred pounds, 36 million. That's in the development stages. Dawn Lake, also in development, indicated 18 million pounds. And then as mentioned, it has royalties on a bunch of properties in the US, right? Reno Creek, Lance, that is Peninsula Energies. And so Reno Creek's in development, Lance is in production idled. That's Peninsula Energy. They're supposed to bring that online. Dewey Burdock is advanced, Church Rock is advanced, right? So the more of these we get in production, the better, right? The more cash flow this company is going to earn. They also have a royalty on the Langer Heinrich mine, Paladin's mine, Paladin's massive mine. That one's in production. They're getting 12 Australian cents per kilogram of uranium produced, measured 100 million pounds, indicated 20 million pounds, inferred 8 million pounds. The Michelin mine, that's in the development stage, and it just goes on and on and on. So the bottom line is royalty companies are generally longer term. Unless their projects immediately kick into production, the cash flows have to wait, right? So they have to wait for the projects to get into production, but they do have royalty streams on Cameco and Paladin's in production mines, right? So, but when it comes to all the other royalties, it's just a longer term game. Right now, if you're in a multi-decade supply crunch, you don't mind waiting because the value of the uranium in the ground should just increase over time as it gets scarcer and scarcer above ground. So it's okay to keep these units in the ground for the future and sell them at higher prices. So these are the pros of investing in a royalty company compared to miners, compared to uranium ETFs, and compared to physical funds, right? So with Uranium Royalty Corp, you have exposure to the uranium price. It has that. Operating companies have that. Uranium ETFs have that. Physical funds have that. Fixed operating costs. Yes, right? Operating companies have a massive amount of operating costs, right? So that eats into their profits. Uranium ETFs also no real costs. Physical funds, no real costs. Or if they do have costs, they're fixed and small generally, right? No development or sustaining capital costs. Correct. All profit. Not so with operating companies or miners. True with uranium ETFs, true with physical funds. Exploration and expansion upside without the associated costs. Operating companies don't have that. Uranium ETFs don't have that. Physical funds don't have that. Uranium Royalty Corp has that. Right, so that's the benefit of investing in Uranium Royalty Corp. We'll talk about the cons of this asset later, but these are the pros, right? Diversified asset portfolio, yes. Operating companies have that. Uranium ETFs have that. Physical funds don't have that. Ability to grow without increased management, yes, right? Royalty companies extremely profitable. They don't need that many people working at the company to increase their revenues, right? So it's a great business model. The only risk with this company is you have to trust management to invest their money wisely, right? Do accretive dilutions that actually accrue value to the company and aren't dilutive to the shareholders. This company loves to sell stock, but they have to make the acquisitions accretive, right? So that is the only risk, really, right? You're hoping that they can do accretive acquisitions. Now, what's positive is we are in the midst of a nuclear renaissance. We are in a multi-decade supply crunch for uranium. So as prices rise, this company's royalties should only increase. So even if they are slightly dilutive now, if the uranium price rises and the nuclear renaissance continues and these assets continue moving into production, then this company should be extremely profitable, right? And it's already generating profits. To me, that is just so massive. A 53 or 54 price to earning ratio. Again, it seems high, but it's not high if the earnings grow. right? So that's the big risk as well. We need the earnings to grow. They look set to grow. This company is definitely exposed to the nuclear renaissance and the uranium supply crunch. So if you believe in those theses, this company is set to benefit from that massively without the need to keep diluting their shareholders. In theory, they could just stop printing stock, let their portfolio of royalties just ride over time. Now, if they find a massive deal, then they can print stock, sell it, and hopefully do an accretive acquisition. But right now, we're so early stage. If we look at the chart of this company, it really hasn't budged. Now, it does have the ability to go up, right? From April 2023 to December 2023, when uranium miners were in a bull market, it did manage to go from like $1.90 to $3, right? So it's not a dead stock, even though the chart doesn't look great. It will go up if the rest of the market goes up, right? It has a proven track record of doing that. A very interesting, profitable company that looks set to take advantage of the mega trend in nuclear, right? We'll have to stay on top of these assets, but so far, so good. Hard to argue with this one.